Well, if you look at the period from the end of the global financial crisis, roughly '09, through the appearance of the pandemic, and then in the 20 and 21, we were, the Fed took extreme measures to save the economy. Mm-hmm. They worked. Very low interest rates, the lowest in history, zero for much of that time, and quantitative easing, the buying of bonds, which puts liquidity into the economy. These things produced what I would call was an easy environment in the economy and the markets. We had the longest economic recovery in history. It was easy to make money.
Right.
We had low-cost capital. It was easy to make a profit. We had very few defaults and bankruptcy. It was easy to stay in business. It was easy to access capital. Everything was easy at that time. And in the last year, of course, with the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder. I imagine people today saying, well, when are we going back to normal, like it was 5, 6, 7 years ago? And the important thing to know is that that wasn't normal.
Right.
That was the easiest, the best of times.
Right.
And my own belief is we're not going back there. We're now in an environment of more normal circumstances, and we're going to roughly stay this way. Well, it's what a sea change is. It's a complete transformation, not just a minor cyclical fluctuation. So, look, I think that the business world, the economic world, is not supposed to be easy. It's not supposed to be easy to make money.
Right.
Or, it's not supposed to be easy for companies with bad business models to stay in business, as it has been for the last 14 years.
Right.
So I think we go back to a period in which we have moderate interest rates, we have moderate availability of capital, we have a moderate default rate, and so forth, all of which will feel much less accommodative, I think, than the last 14 years. It depends on your definition of stable time-wise, but of course, I think that the Fed became activist with the arrival of Alan Greenspan in the mid-90s, and I think that it's, we had, people started to talk about the arrival of the Greenspan put, that if there was a problem in the economy, the Fed would just squirt in some liquidity and solve it, and frequently did, including Y2K and other real and imaginary crises, the arrival of the bursting of the TMT bubble, for example. So I would say that that's 25 years that we haven't had what I call a free market in money. I'm applying common sense. You can't always count on common sense, but the events of recent years tell me that it's not great to have interest rates at zero. Zero interest rates are really an emergency measure. Somebody gets a heart attack, you give them a shot of adrenaline. Works.
Right.
That doesn't mean you start your day with a shot of adrenaline every day for 7 years.
Right.
We had rates at zero for 7 years, and I think that and by the way, by the time 16, 17, 18 rolled around, people started to say, well, shouldn't rates be a little higher so that if we have a recession, the Fed can cut rates and become accommodative. Well, if rates are a zero or a quarter or a half, you can't do that.
Yeah.
So I think that's an important reason why rates should be positive. And if you want to fight inflation and kill off inflationary psychology, which is very important, you need a positive, real Fed funds rate.
Right.
That is, the Fed funds rate has to exceed the rate of inflation, because Mark Twain said, history does not repeat, but it rhymes. We haven't had much experience with inflation. I lived through the last one, which was in the 70s, a most unpleasant decade. Right. But then I think the situation was different. The sources of the inflation were different, and of course it reached the mid-teens.
Right.
I think we're not going there this time. I think that the original reasons for the current bout of inflation, too much money chasing too few goods, money from pandemic relief, money people put in the bank in 20 because they couldn't spend it, and then a supply mechanism that was sputtering, too much money chasing too few goods. That will correct over time.
Okay.
The extra money will get spent, supply will catch up, I think the forces behind inflation will abate. Anybody who joined after '09 pretty much only saw good times, except for a couple of bad months in 2020 in connection with the pandemic shutdown. But, you know, for my first 30 years in high-yield bonds, 78 to '08, the average default rate was about 4% a year. In the last decade, it was only 2% a year. I think 4 is more normal. And, you know, defaults and bankruptcies should not be that scarce. And I think we'll be going back to a somewhat harsher environment. Well, the prices, the current prices are roughly sustainable. When you say, is the rally sustainable, they're not going to keep going up. That is to say, yields are not going to keep coming down, in my opinion. You know, I think that rates are roughly where they can stay, except that I think it's important to recognize that the debate today is being dominated by people who are optimistic, by people who think that the recession won't be too bad, won't be too long, that the inflation will give way, and that the Fed will be able to turn accommodative. You know, I think that the Fed is going to want to be somewhat strict and hold that position, well, let's say, throughout the year. I don't think the Fed wants to be seen as being optimistic, you know, hawkish, dovish. They want to have some constancy. I think that in many areas in the stock market, for example, that a significant degree of optimism is ruling the day today. And if you want to look at pessimism, look at June, look at September. You know, then people were not so optimistic about this pivot towards dovishness. So, and we've been going back and forth, and the S&P, for example, has been trading in a channel between 3,700 and 4,000. Depending on whether the optimists or the pessimists were in the ascendancy. Right now, I think the optimists are in the ascendancy. Who knows how the events will bear them out. We're what's called bottom-up investors. We're not strategic. We don't say we want to have so much in America and so much in Europe and so much in steel and so much in paper. And let's find some companies. We just look for pieces of paper that look reasonable from companies that we think will stay in business. I would say value. You know, if we as creditors can buy the debt of a company that we think can stay in business because it has a good business model and some margin for error in tough times, and if we can buy the debt at a place in the capital structure where we create ownership in that company potentially at a reasonable valuation, that's what we look for. What we saw really was this sea change, Romaine. You know, prior to '77, which I think, or '78, which was the advent of high-yield bonds, a bond rated below investment grade could not be issued. Moody's defined a B-rated bond as follows: fails to possess the characteristics of a desirable investment. In other words, bad idea. After Milken and others arrived in '77, '78, the new way of thinking was, well, it's not a great company, but the promised rate of interest is enough to compensate for the risk. And for the last 45 years, and I think for the rest of time, we don't think of good idea, bad idea. We think risk return, risk return. Is it, how risky is it? Is the promised return adequate to compensate for the risk? And you know, that's very important. So the point is that the people who started to do this early, you know, I was lucky to be asked to form a high-yield bond fund by Citibank in '78. The people who started doing it earlier could find places that people were saying, oh no, we wouldn't touch that, that's low grade. And where you could get a high return without taking much risk. You know, that was kind of a free lunch. Efficient markets tend to cause free lunches to go away. But it was great to get there early.